What if I told you that in 2025, 3 of the biggest tech companies on Earth might have pulled off the most elegant financial illusion in modern history? A loop of hundreds of billions of dollars that made everyone richer without actually creating anything. Sounds impossible? Let's take a closer look. To understand what's really going on here, let's start with a short story told in 3 acts. Act 1, September 18th, 2025. OpenAI signs a $300 billion deal with Oracle to provide computing power for artificial intelligence. Oracle's stock jumps by 1/3, and for about half a day, Larry Ellison overtakes Elon Musk on the list of the world's richest people. Act 2. That same day, Oracle signs another deal, this time with Nvidia, to supply chips for the exact same computing infrastructure. The deal is valued at $40 billion, with the potential to grow to $300 billion. Shares rise again. The market loves it. And then comes Act 3. On September 22nd, 2025, Nvidia announces an investment in OpenAI, $50 to $60 billion per gigawatt of capacity, potentially scaling up to $500 billion. And that's when investors start scratching their heads. Let's repeat that for anyone who missed it. First, OpenAI gives cash to Oracle. Then, Oracle pays Nvidia. And finally, Nvidia invests that same money back into OpenAI. In the process, the stocks of all 3 companies go up because regular investors see the flashy headlines and rush to buy in, while Nvidia, Oracle, and OpenAI quietly sell their shares, taking real profits. Let's repeat that again. These profits aren't from products. No one has actually built or sold anything yet. The $300 billion just bounced around between 3 balance sheets, and the profits came from retail investors who poured money into the hype. Now, if you swap those corporate names for individuals and replace OpenAI with, say, Sergey Mavrodi, it starts looking like a Ponzi scheme where nothing of real value is created, but money just circulates within the system. All the so-called hamsters, the small investors, end up being the ones left holding the bag. And that's exactly what major media outlets from CNBC to Forbes to the Financial Times have been warning about in recent months. An AI bubble that's dangerously overinflated. Whether that's true or not, we'll find out in the next few minutes. So please like this investigative report, and don't forget to share your thoughts in the comments below. We hear about artificial intelligence every single day, but few people realize it's no longer a toy, it's a new economy. And when you look closer, it starts to feel like a quiet horror. In 2025, AI accounted for 80% of the total growth of the US stock market and nearly 40% of the country's GDP growth. That's $1 or $2 trillion. By the way, roughly the size of Italy's entire economy, conjured seemingly out of thin air in less than a year. No one has built the data centers yet. Super intelligent AI isn't even on the horizon. All that growth is just a virtual $300 billion being passed around like a hot potato, a financial game played between Nvidia and OpenAI, while millions of people, banks, and institutions are putting real money on the line and could lose everything if the bubble bursts. That's why analysts are sounding the alarm about a potential repeat of the dotcom bubble. For younger viewers, that story unfolded at the turn of the millennium, and it's eerily similar to what's happening now. Back in 1995, when the internet was just taking off, everyone believed it was the future. Companies like Netscape, Yahoo, and later Google and PayPal were skyrocketing, and investors went absolutely wild. Literally any company with .com in its name could raise billions the moment it went public, even if it was selling, say, underwear online at 3 pairs a week. Didn't matter. Everyone had beautiful charts, big promises, and insane growth projections. This is where we have to talk about one key metric, the P divided by E ratio, the price of a company's shares divided by its annual profits. Roughly speaking, it shows how many years it would take for a company to break even at its current pace. During the dot-com era, most startups had P divided by S above 100, meaning it would take a century to make back what investors paid. Still, people kept pouring in, expecting explosive growth. And honestly, that's not necessarily wrong. That's what the stock market is all about, betting on a rough stone that could turn into a diamond. Take Tesla, for example. In 2020, its P divided by E ratio was a mind-blowing 1,274, meaning it would take until the 4th millennium to break even. Yet, the company kept growing, revenues climbed, and the ratio eventually dropped. The key question is, will revenues actually grow? Because the last time, around the year 2000, they didn't. In March of that year, investors rushed for the exits and the crash began. By 2002, the US stock index had collapsed 78% from its peak. The big players like Elon Musk, who sold PayPal just in time, walked away rich. But ordinary people, even those who never touched the stock market, ended up paying the price. Because the stock market is a place where profits go to the owners, and when losses come, banks go to the government. The government hands out money and then takes it back through taxes and inflation. If you've seen The Big Short, you know exactly how that works. And there's one final piece of the puzzle we need to remember about the dot-com crash of 2000, the role of Cisco. While PayPal and Google were attracting investors with their products, Cisco was quietly building the backbone of the internet. The company manufactured routers, switches, and all the networking equipment that made the digital revolution possible. You know the saying, during a gold rush, don't look for gold, sell shovels. That's exactly what Cisco did. It sold the shovels. And by the year 2000, it had become the most valuable corporation on the planet by market capitalization. Then it crashed harder than anyone else. Fast forward to today. Nvidia is the new shovel seller holding a near monopoly on the AI chip market. The engines that need those shovels are the AI startups, especially the much-hyped OpenAI. Its market cap is already estimated at $500 billion. Nvidia itself is now the most valuable company on Earth, worth $4.5 trillion. If Nvidia were a country, it would rank fourth in global GDP, right behind Germany, which, you'll agree, is a bit strange for a corporation with only 36,000 employees. That's exactly why investors are starting to get serious. .com déjà vu. But there are counterarguments, too. As of October 2025, Nvidia's P divided by E ratio is just 53 tiny compared to Cisco back in 2000 or Tesla in 2020. And it's true, AI really is everywhere. Even grandmas use it now, not to mention cars, medicine, and scientific research. Plus, this time, the AI boom isn't fueled only by private investors. Entire governments are pouring money into it. So, theoretically, a collapse should be impossible, right? Unfortunately, no. That same sense of invincibility surrounded Lehman Brothers, the fourth largest investment bank in the US, before it collapsed in 2008. Many thought it couldn't happen because it had government backing, but it did. And that failure triggered the biggest financial crisis in modern history, one that made the dot-com crash look small. In reality, government support doesn't prevent a crisis. It just makes it global when it happens. And the closer we look, the more troubling things get. Nvidia's low P divided by E ratio comes from its enormous revenues. But where does that money actually come from? The most famous segment is gaming graphics cards, yet they make up only 8.7% of Nvidia's revenue, about $11 billion. The overwhelming 88% comes from something called AI data centers, basically, sales of chips and hardware to the biggest players in the market. But wait, that's exactly where we started this story. That legendary $300 billion OpenAI spent on Oracle, which Oracle then paid to Nvidia, which Nvidia conveniently invested back into OpenAI. It's like putting money in your winter jacket, not marking it as an expense, and then, months later, finding the jacket and recording it as income. And since you're the jacket's owner, you can do it forever, creating as much imaginary profit as you want. In short, this is exactly what analysts are complaining about when it comes to Nvidia. The company has bought stakes in OpenAI and owns shares in a dozen other AI startups. And, just recently, it invested in Elon Musk's xAI. Guess where Musk spent that money? That's right, he bought more chips from Nvidia. To put it simply, it's like a shovel manufacturer owning the land, organizing gold prospecting tours, handing out shovels for free, and only asking for a share of whatever gold people find. In the real world, the success of that shovel maker would depend entirely on whether the prospectors actually strike gold. So yes, Nvidia can technically be written out of the bubble equation. The company is doing everything it can to keep the hype alive and profit from it. But ultimately, the bubble's fate depends on whether the AI players can make real money. That's exactly what happened with Cisco. The company never disappeared. It still produces world-class equipment. It's just no longer trendy. The hype faded, its stock price crashed, and now only system administrators even talk about it. But here's where the real problems begin. OpenAI's net profit for 2025 is projected at -$8 billion. During the dot-com bubble, giants like Google were already making money this time. Not even close. The biggest AI startup in the world is still operating at a massive loss. And Sam Altman doesn't expect profitability until 2029. Anthropic is losing $2 billion in a year. Musk's xAI is $5 billion in debt. Copilot, Gemini, and Llama are only surviving because they're backed by tech giants like Microsoft and Meta. In short, even though AI is in every smartphone, the companies building it are still surviving on Nvidia's subsidies and investor faith. The business is nowhere near profitability yet, which, to be fair, isn't unusual for a new market. BYD, founded in 1995, didn't turn a profit until 2003. Cattle took 4 years. Amazon needed 9. Tesla 17. Being in debt early on is normal. The difference is that BYD makes cars, Amazon sells everything from books to rockets, and Tesla builds actual hardware. OpenAI, meanwhile, makes money on, well, no one's entirely sure what Sam Altman is profiting from, apart from ChatGPT subscriptions, and even that business is under threat. Because no matter how many fancy paid models you release, there's always going to be some brilliant team in Asia like DeepSeek that'll offer the same thing for free. Still, OpenAI projects its subscription revenue to grow from $6 billion today to $55 billion by 2029. Experts are skeptical. With so many free alternatives and the visible ceiling, AI seems to have already hit text, images, voiceovers, videos. There's not much room left to wow the market. If you make a YouTube video with AI, you can't monetize it. Personalized AI advertising? Still just a dream. And to make matters worse, OpenAI is drowning in lawsuits. Beyond subscriptions, the company's business model looks like chaos. Its alternative income sources, government contracts, and, believe it or not, more collaborations with Oracle, Nvidia, and other corporate partners. In other words, it's the same story again. Money shifting from one pocket to another. This is the core of what analysts call the BBB market problem, a $1 trillion bubble forming by October 2025, where cash just circulates in loops. Even AMD, which was promised a 10% stake in OpenAI, has gotten tangled in it. Wall Street now whispers that this whole setup is a conspiracy, a repeat of 2008, when banks traded bad mortgages among themselves until the system collapsed. And here's the scary part. The market cuts both ways. It can send stock prices to the moon, but it can just as easily drive them into the ground. If that happens, everyone will feel it, because, in a sense, every taxpayer on the planet has skin in this game. If AI really is a bubble, it won't just be Silicon Valley that pops, it'll be all of us. And, as always, the corporations will be fine. But, just like in 2008, it'll be teachers, nurses, and plumbers who end up paying the bill. So, what do you think? Does the AI industry look like a bubble or the beginning of a new era? Share your thoughts in the comments below. That's all I have for now. Bye.